Alrighty, so it looks like a couple more people were trickling in, so we're going to go ahead and get started for everybody tonight. Once again, I am Derek Gales. I'm the marketing manager at iPlanGroup, and I would like to welcome you to our weekly educational call. This week we're going to be talking with Shaun Cohen. He is the president of EquityBuild Finance. He is also the vice president of EquityBuild, and we also have Erica Kelly on the line, who is the iPlanGroup senior IRA expert. So for any more technical questions regarding a self-directed IRA or anything like that, Erica is going to be chiming in from time to time on the call. So we do want to say thanks for everybody. As you can see on the screen, you can see how you can get in touch with both us at iPlanGroup. It's a link we have right there, iPlanGroup.com/strategy. We'll take you to a page where you can set up a free 30-minute IRA strategy session with somebody, with either Erica or one of our other teammates over here at iPlan. If you want to get in touch with EquityBuild Finance, their URL is right over on the right, and you can talk to them there. I'm sure Shaun will give you a bunch of ways you can get in touch with them. So without further ado, I'm going to go ahead and pass this on over to Shaun. Shaun, you ready to take the reins here?
I'm ready. Derek,
Right.
Derek and iPlan, I really appreciate the opportunity. You know, we have recently been doing a couple deals with iPlan, and I have to say that so far in this industry, I've worked with a bunch of IRA custodians, and they have been by far the best company I've worked with. The customer service has been fantastic, so my hat's off to you guys. You've done a fantastic job, and thank you for the opportunity here.
Yeah, no, thank you very much. And you know, the one thing that we like to stress is that iPlanGroup was founded by investors for investors. So, you know, our kind of main goal every single day is to make sure that, you know, none of any of our clients' deals fall through because of misfiled, incorrect, or missing paperwork. So I'm really happy that you were able to get those things accomplished. We hear that all the time. So I'm going to stop talking about us and let you take it over.
All right, sounds good. Listen, I appreciate it, Derek. So today I'm going to be speaking to you about the, you know, really exploiting the real estate bubble collapse. It's, you know, titled The Greatest Financial Opportunity of Our Era. You know, first of all, thank you so much to all of you for coming on this webinar. I know we're all taking precious times out of our lives, so I'm going to do my best to work through this as quickly as possible. But it's really impressive to see how many people have joined us tonight, so thank you all for devoting your time to tonight. So this is me, Shaun Cohen. The name of both of our companies is EquityBuild and EquityBuild Finance. Here is a typical disclosure disclaimer. Read through it as fast as you can. I know there's a lot of stuff on here. Basically, it's just saying that I'm not offering, in this webinar, we're not offering any securities or really or anything in any way other than an experience of what it is that we do. And you get to learn about what it is that we do in the industry that we're in and how we do it. There's a little caveat to tonight. I have had the flu or some version of it for the past couple days, and you are not getting the best me tonight, so my apologies for that, but my brain is not working all that well. So if there's anything that, you know, I don't really address as well as you would like me to, please reach out with questions. So I'm definitely not in the best of all shape right now. Here's my promise to you, that today is really that if you pay attention and apply what you learn here today, you really will begin the path that will lead you to financial freedom and wealth. And look, if you stay until the very end, I will show you a neat trick that really has allowed our clients to power their wealth building in ways that they've never dreamed, and really ways that they can't be achieved in mostly anywhere. Just a quick note, please turn off all your phones, email notifications, Facebook Messenger, whatever other kinds of, Twitter notifications. Grab a pen and notepad. We're going to be moving through a lot of stuff. There really is a lot to cover, and I really don't want you to miss anything. So just a quick note about EquityBuild and EquityBuild Finance. It's a family-run business. My father and myself both own both companies. My father is the president of EquityBuild. I am the president of EquityBuild Finance, but we both work hand in hand. And really, I run all the sales, marketing, and business development of both companies. My father handles most of the product fulfillment. And so here's more of an elaboration on the story. So it all started in 1984, and and I was too young to be in that band, and my father definitely is not one of those members. But what really happened in 1984 was, if you look at the top picture, you see an incredible long line of people. And if you look at the bottom picture, a whole bunch of dilapidated houses. So we were from Philadelphia, and what happened was my father was driving around the city in 1984 and saw this humongous line wrapped around city blocks. And a couple days before that, had read in the paper that there were around 20,000 vacant buildings in the city of Philadelphia. And after he had taken his trip around the city and saw that long line, he again opened up the paper and saw that Section 8 vouchers were being given out, and there were about 20,000 applicants. So really, what he saw there was an opportunity. You've got 20,000 people or thereabouts looking for housing, and 20,000 vacant dwellings in the city of Philadelphia. And there's a mismatch there. So to him, that was a business opportunity and a reason to begin his venture in the real estate business. In 1989, he had become one of the largest residential real estate investors in the Mid-Atlantic. He amassed a portfolio of 425 properties. They were all residential. And if you are familiar with Philadelphia, most of the homes in Philadelphia are single-family row homes. And so he had 425 single-family row homes. And by the age of 10, he had actually bought me my first property, but I was fully responsible for every element of it. If it crashed and burned, that was all on my shoulders. I was responsible for the maintenance of it, the property management, and by the time I was 12, I had 5 properties. And so, as you can see, real estate is very much in our blood. As time went on, my father decided to challenge himself in other ways. He had built 2 companies in addition to the real estate business, and that had nothing to do with real estate. And really, the first one that he built, in a very short period of time, became the second largest two-way radio dealership in the country. But what was happening is, all along the way, some friends and family were asking for help. They were asking for help in building their own rental portfolio. And so really, I went to my father and I said, look, how can we take your experience and bring it to the masses? How do we bring it to people that maybe don't have the time or they don't have the experience to be full-time real estate investors, but they understand the value that can be derived in real estate? And so that's really what started the whole concept of EquityBuild. But there's this concept in this country, for some reason, that one can overnight become a full-time real estate investor. You have real estate gurus that are selling these DVD sets or CDs or books or weekend seminars that if you come here by the end of the weekend or by the end of the book or DVD set, you'll know how to be a full-time real estate investor. Well, I truly believe that that's not really true. I don't know how many of you are familiar with Malcolm Gladwell's Outliers, but really, the concept there, if I were to paint it in broad strokes, is that really you need 10,000 hours of focused practice in really anything that it is that you want to do, any skill set it is that you want to hone. So if you're a teacher, or if you're a plumber or an engineer or a doctor or a lawyer, or whatever it is that you do with your life, if you focus 10 focused hours on that skill set, then you can master it. And that's through mentorship. That can be through apprenticeships, through working, through schooling, whatever that might be. Well, so if you haven't read the book, then you don't know about the 10,000 hours, but many of you probably have heard that it takes 5 years to get a business out of first gear, really, to get it to be moving in a profitable direction, right? Well, 10,000 hours is actually 250 weeks, which is almost 5 years. And so what you can glean from that is that there's no difference between any of what I just said and becoming a full-time real estate investor. If you are not there, if you haven't had 10,000 hours of practice, then you are staring right now up a hill that is 10,000 hours high. So here's what we do. So the equity build model is really to help people build wealth, and that's including the novice, and it's really designed for the novice. And so what we do is we do that by using real estate. And so really everything that you can conceive of that is needed to first identify a strong property and then take that property and turn it into a productive asset for its life. We handle all of it. So you can see the list there, the market analysis to determine which markets are the most viable in the country, which ones produce the best cash flow, the property selection, the inspections of that property. We do 3 inspections before a property is ever even bought. There's the rehab, the leasing, the property management, marketing, if it's to be a sale, etc. So what happens is EquityBuild, when we do the market analysis across the country and we determine which markets it is that are the most profitable from a cash flow perspective, we whittle it down even further. We apply some more stringent metrics and whittle it down even further to that one market. And we then enter that market and become a household name. And we become one of the largest buyers in the market. The 3 opportunities with our company is, number 1, on the rental side. If you want to build a rental portfolio, our clients build a rental portfolio. They can do it in residential. That's anywhere from a 2-unit to a 4-unit. And commercial, which is still a residential class commercial. So it's going to be just apartment buildings. And that's 5+ units. We do flips. That's buying and selling properties, which single-family residences and also failed condo conversions. And then thirdly, private lending. And that's a direct loan with a first lien position. So that's direct between the lender and the borrower. We are in the middle as a servicing company. So this is just a side note, and for those of you that don't know what this means, to be SIP approved in the UK, it's really a huge deal. It's a massive undertaking. You know, the UK is a highly regulated country, and to actually become an investment company that is approved is just a massive due diligence process that we underwent. And so we are now actually UK SIP approved. And what that means is, and the reason that we became UK SIP approved, is that we have now teamed with 2 hedge funds. One is called Project Kudos, they're out of the UK, and the other one, Infinity Treasures, out of Singapore. And we've formed a company called Rebuilding America. So again, this is a side note in addition to EquityBuild and EquityBuild Finance. It's a recent development in our business. And so basically the concept is that with the money that they're going to be pumping into our model, we're going to take our model and we're going to go city by city and revitalize those cities. And that's going to be by teaming up with mayor's office or other influential city officials. Like, for instance, if you're in Chicago, the city aldermen are actually more powerful than the mayor when it comes to this business model. So depends on the city, but that's the concept there, and that's what we're going to begin implementing starting next month, actually. So here's the team. Yours truly. I have a master's in economics from George Mason University. I was a PhD candidate. I just really, honestly, what happened was my wife and I were both in the same program, and we had our first child and realized I was working full-time and going to school part-time. She was in school full-time. And we basically realized that we were being really bad parents. And so we finished up by passing all the exams we needed to pass in order to continue on to the PhD track in case we decided we wanted to re-engage, but we did end with our master's. But as a result of my education and really the way that I was raised, I really have a great understanding of market dynamics, politics, economics, what exactly is going on in the world right now, and how to help protect our investors' wealth and grow based on those dynamics. As I spoke earlier, I was raised in the world of real estate, and on the lending side, I was formally trained by one of the most stringent underwriters in the private mortgage note lending industry, and so I have a lot of experience in that world as well. And there's my father. Really everything that's on here I've kind of gone over already. his experience from 1984 to 89, what we've done. Over the years, we've orchestrated well over 1,000 real estate transactions, and at least 450 of those have been with EquityBuild. He's negotiated for bought and sold businesses and assets worth hundreds of millions of dollars, but really what he specializes in with respect to this business is he analyzes and selects markets using his own proprietary real estate market analysis tool. And then from that, once we get into that market, as I said earlier, builds out the investment infrastructure, the asset acquisition, construction resources, the maintenance team, property management, legal, finance, so on and so forth. And so in the end, it becomes a totally turnkey experience. So it truly becomes a passive investment experience for the real estate investor. Ken Asbridge is the president of G-Slow Construction. G-Slow is a company that we partner with fully in every element of our business in Chicago, actually. That's where we operate right now. And what Ken Asbridge brings to the table here is an unbelievable resume. He's been in the business for 46 years. He headed construction for Sprint Communications, so he built all of their offices throughout the country. Home Depots, Walmarts, Walgreens, the Sony display centers that you see in malls, satellite systems for General Dynamics, hotels, schools. If you're in Chicago or if you're in the Chicago area, the vast majority of the suburban schools he built, designed and built. Some municipal high-rise buildings, worked on the Trump Tower, built a TV station in the Sears Tower. Strangely enough, built Roseanne Barr and Tom Arnold's house, and won the DBA Contractor of the Year award. And then we have George Slowinski, who runs G-Slow. He actually came from RE/MAX and was one of their top agents in the nation. As you can see here, he was in he won the Hall of Fame award in 2008, which means you have to earn $1 million or more in commission. One of the things that he's been able to develop in the systems that we've created on the G-Slow side and the real estate and then the property management side is the recognition that we've received, even across the country, is pretty phenomenal. So he's actually one of the top agents on Twitter and top 50 in the nation on Trulia. And Chicago Magazine, for the past 2 years, has rated G-Slow as in the top 5 in all of Chicagoland. So now that you've met us, let's walk through the political and economic landscape. So look, we all know what we've been going through. That's both politically and economically, what we're currently going through. The question really is, where are we going and what does the future hold? So the annual deficit for 2012 was right around 1.1 trillion, right? And that is the number, that's the difference between the government's expenditures and its receipts. Now, if you go on budget or off budget, it's a completely different number, but let's not focus on that for now. We'll use what the government statistics will show you, right? And there are 3 ways that the government can pay that money back, what I call deficit remedies. Number 1, it can tax you more. Number 2, it can borrow from you, companies, or other nations. Or number 3, it can print money. So let's talk about number 1. If the government raises taxes, then there will be less people in the workforce, and the receipts will actually decrease, causing the deficit to grow. That we know historically from other nations and from what's happened in this country doesn't work. Well, let's say the government can borrow money. They can borrow money from you. They can borrow money from other countries. Well, right now we have a massive problem with that. The government's borrowed so much from China that there is a possibility at some point in the future, and I do say this jokingly but tongue-in-cheek, there is a possibility in the future that our flag might change. Again, that is tongue-in-cheek. So really the third thing that they have, is printing money. Sorry, a little problem with the slideshow. But the third thing that they have is printing money, which really causes inflation. And if you look at historically the way that inflation is calculated, there are really three models that can be used. One is the model that was used in the 1980s, one that was used in the 1990s, and then one that is used today. If you go back to the 1980s, we're tracking at about 10% inflation today. If you go back to the 1990s, we're tracking just above 6%. And if you go to today, I think the government has it reported at somewhere around 2 to 2.4% or something like that. I don't know what the most up-to-date record is there. But if you look at really what the difference is there, the difference is that the bundle of goods that they were using in 1980, if any layperson were to look at that, would say, well, that makes sense. And then in 1990, well, that kind of makes sense, but a little bit less sense. And then today, well, that doesn't make sense at all. So really, what does that mean? If inflation is tracking at 10 or 6% or whatever that number is, whatever your money is earning for you needs to track greater than the inflationary percentage. Otherwise, you're losing money. Your capital is declining. And so what does it really mean? What it means is that we all really need to be abandoning cash and placing it in items that have inherent value, like real estate or gold or silver, food, water. The problem with everything but real estate is that really none of them generate any income. But anything that can be severely hit by inflation, like stocks, futures, money markets, CDs, T-bills, really, in my opinion, that should be run away from. So let's dive a little bit deeper. There are three investment options. You have safe investments, you have risky investments, and to me, real estate. Safe investments, they typically offer lower returns. That would be your CDs, your money markets, your T-bills. Risky investments, potentially higher returns, but they are risky. That'd be stocks, futures, commodities, angel investing, venture capital, etc. Real estate has reasonably high returns and is safe, but it's typically not passive. You're typically one property manager away from being the property manager yourself. So let's look at the safe investments. So as of December of last year, the best adjusted percentage yield, or I'm sorry, annual percentage yield on a CD was 1.51% on a 1 year and 2.53% on a 5 year. On a money market, the best is 1.1%. Treasury bonds, the best is on a 30-year bond. That's 30 years. It's 3.18%. Even 10 years is at 2%. So again, with inflation rearing its ugly head, and there has been talk of hyperinflation, any one of these ensures a loss of your capital over time. Let's look at risky investments. The stock market. Obviously, the stock market is cyclical. It goes way up, it goes way down, and it can do either of those for an extended period of time. Now, one of the biggest issues with the stock market is this. If you look at the bottom graph is of the Wilshire 5000, which is the composite index, and that reflects the broad market. So what you'll see is that in 2007, the market was right around 14,000. And if you look at the graph above, you'll see both the market positions and estimated assets of the hedge fund industry alone. And you'll see that in 2007, the market position of the hedge fund industry was just above 5,000, which is about 36% of the entire market. And this is only hedge funds, not all institutional investors. So if you include mutual funds, insurance companies, pension managers, etc., the market position would be closer to 50 or 60%. So what does this really mean? What it means is that large institutional investors have a disproportionate control over the size and directions of the movement of the market. Hedge funds routinely play with, basically they routinely play with the market since they have secret information about how to rig it. So basically, unless you're on the inside, you're really just praying that you're riding on the coattails when the market's going up. And by the way, I found an article written in March that references a study done that shows that institutional investors today have about a 57% share of the total assets in the market. So there you go. So one of the major issues about the way that the stock market is presented is that it's not typically adjusted for inflation. So let's look at how we can make sense of this. So the Dow Jones was down around 2,080 in 1900 and 13,104 by the end of 2012. But the problem is that inflation has $1,900 at 28 times the 2012 dollars. So really the market went up less than 10 times since 1900. What that really means is the annual real return for the whole history of the market is only 1.64%. That's paltry.
Hey, Shaun?
Yeah.
We had a quick question come through. So it asked, what is Methuselah? Methuselah.
Methuselah is the oldest living person in the Bible. I think he lived, I don't know, something like 908 years, some ridiculous number. All right.
Gotcha. And while we're here, we got one more question. I think this one's going to Erica. So we had a question about self-directed IRAs. What kind of LLC do you recommend, local or Nevada? And what are the pros and cons of those, and what are the fees for that?
Can you hear me?
You there, Erica?
Yes, I'm here. Derek, I'm sorry. I cannot see the questions. Oh, wait, you know what?
I can read it off.
Yeah, say it back to me, because I cannot see the questions coming in.
What kind of LLC do you recommend, local or Nevada? That's the question. And then what are the pros and cons of those, and what are our setup fees for an LLC?
All right, we don't set up LLCs here. Our function is strictly passive. We facilitate retirement accounts. You can invest into an LLC. That would have to be established outside. Generally, Nevada is a pro-business state for LLC purposes. There are some general other states that people typically use, but Nevada is a big one. I don't know specifically why, just that it is a pro-business state. The LLC offers an added layer of protection, which we can kind of get into on a strategy session. I don't want to completely monopolize this whole discussion, so we can certainly talk about that after this. But you know, it is something that you can facilitate. You can use a self-directed IRA to fund an LLC. Nevada is a good state to set that up in, but we don't set those up here. So you know, let me know if you want to get in touch after that, and we can kind of go further into that.
Okay. Sorry about that, Shaun. You can take it away.
All right. So continuing on with risky investments. So a sophisticated angel or venture capitalist will have historically hit 200. So really, basically, what that means is that out of every 10 businesses that investors invest in, 2 are home runs, 3 are disasters, and 5 are break-even. Commodities. Commodities really, in my opinion, are largely determined in backroom deals through politicians, lobbyists, and mystery men. And futures and derivatives. Look, to me, if you can truly tell me that you understand why the price of oil goes up and down, then call me immediately so I can get in on it, because oil prices no longer have much to do with supply and demand like I learned in school. You know, a friend of mine is an oil futures trader, and when I asked him what makes him successful, what things he looks for, what signs, he told me that really he has no idea, nothing makes any sense, and he just goes based on his gut feeling. So, you know, maybe one of you was born with a prophetic sense, and if so, I'd love to know what you know. So now let's talk about real estate. So we all know what we've been going through with respect to the real estate collapse, or what we went through. And as you can see, there have been 2 significant anomalies over the last 120 years. The period beginning with the Great Depression and ending after World War II, where if you were a buyer, you'd have enjoyed the large gains you can see evidenced from that point until the Great Bubble collapse of 2007. And right now, we're in a period where prices have returned to near or under the trend line in most U.S. markets. In some markets, that's changing, and it depends on where you're located, but in some markets, bubbles are forming again. But for a whole in this country, that is the case. So really, what are your options? Well, here's the real estate opportunity. So right now, there is a massive inventory of foreclosures and short sales. There has been for a long time. There's continuing to be so. And really what that means is that there's a huge and growing supply of renters and high rents and extraordinary cash flows. It also means that there are lower prices, and that really creates an opportunity for savvy investors. So here's a hypothetical example. So let's just pretend that the bank had this property and it needed $50,000 in rehab and renovation. All right. Now let's pretend they would sell it to you for $10,000. Again, let's pretend that the value once renovated is $100,000. So if a savvy real estate investor found this opportunity and got it into market shape, then he or she is looking at a profit opportunity of $40,000. That's pretty nice. But what if you're not savvy? That's what we offer. So number one, you can become the bank. So what is a private mortgage loan? Private mortgage loan is conservative. It's a conservative short-term obligation with all the security, protection, and recourse of a mortgage lien. It's used by property investors to jump on hot real estate deals, so they can't wait for the bank. The capital comes from individual investors, so not from banks. And it's used in both residential and commercial real estate transactions, and typically has a very high interest rate associated with it of 12% or more. What's a private mortgage lender? It's really just somebody that lends to well-qualified real estate investors who are in need of those short-term loans to take advantage of hot, time-sensitive real estate deals that would not otherwise qualify for traditional financing. So the traditional paradigm is that low risk, low reward, and high reward means high risk. Low reward, low risk would be CDs, mutual funds, treasuries, etc. Or high reward, high risk would be those commodities, futures, startups, etc. But really, what I'm teaching you today is that it doesn't have to be that way. You can have relative safety and high returns. The first rule of investing is to never lose capital, and the second rule is never violate rule number one. Before we worry about returns on investment, let's make sure we get a return of our investment. So what are the risks? Well, really the risks are late payments. If there are late payments, you get extra charges. You charge more for that. An extended term, so a late payoff would be more of that 12 or more %. Default remedies. So default remedies, number one, there is an assignment of rents written into every mortgage. And so what that means is that if the borrower defaults, automatically the rents that are being generated by that building get diverted over to the lender. And in addition to that, a deed in lieu of foreclosure. But really, one of the most important elements here is that the lender is lending to an investor. And in lending to an investor, if you're an investor that buys a real piece of real estate and you're renovating it and the deal just winds up being a bad deal, you don't want to stomp your feet in the ground and fight. You want to walk away, wipe your hands clean of it. So the real notion of the foreclosure process and what goes on there, typically, not universally, but typically, that's more so the case for somebody that lives in the building, for when it's their primary residence. When you have an investor, that's not typically the experience that you're going to have. Again, that's typically, but not universally. And in that case, the default remedy there would be that a quitclaim deed could be signed over, or if you have to go through the foreclosure proceedings, you go through them, and then you own the property, which we'll discuss more later. But underwriting is really king. So number one, you have the collateral, and that is is really, really crucial. And so on this slide, what I want to start to do is to really tie together all the pieces of the business. What you have to keep in mind is that you have EquityBuild that is finding these properties for novices, not universally a novice, but that's the model that we have. And in order to deliver that kind of model, we have to have intelligent systems in place that can deliver a passive experience to a novice. So we have EquityBuild that is finding the properties, doing a whole bunch of research on those properties, tons of inspections on them, has attorneys that are reviewing violations on the property, that are reviewing administrative hearings that may exist, judgments, liens, so on and so forth. And then once the property is bought and sold to a client, EquityBuild is then renovating the property. And once the property is renovated, EquityBuild is then finding tenants for the property. Once tenants are found, EquityBuild is managing the property. So EquityBuild is doing absolutely everything. Now, the buyers themselves are all A-paper borrowers. So these are all people that have 700, 800 credit scores, they have money in the bank, sizable retirement accounts, they have strong income. These are all model citizens. And so kind of going back a little bit to the interest rates that can be achieved here, one of the questions that's going to pop into most people's mind when I say that these are A-paper borrowers is, well, why would they pay such an enormous amount of money? Why would they pay such a high interest rate to a lender? And that question is probably one of the most common questions I get, and a very important question. So I'm going to begin by answering it with an answer that exists today but did not exist in the past, but does exist today and is not the primary reason, but is a reason. And really, that is that there used to be, in the banking world, a product called a construction to perm loan, where they would issue construction financing, so a renovation loan, and then turn that into permanent financing. That doesn't exist anymore in the banking world. Now, it might exist on a real local level. If you were to go to a local bank and you're investing in a property locally, but that's not going to exist at the national level anymore. So number one is that all these properties are distressed and they need some TLC and that they need that renovation. And so the only way that borrower today can get that property is by going to a private lender. That's number one. But really the more primary reason is that let's pretend you're Bank of America. You've foreclosed on, I don't know, 5,000 properties this month nationwide. And within your market as an investor, maybe there are 300 properties that they foreclosed on, and there's a list. You go and you look at that list, and you see a property that you like. Well, if you don't have the cash to buy that property, you'd have to go over to Wells Fargo and go borrow money to get that property. So again, we're pretending that Wells Fargo does have that construction to permanent financing loan, right? The problem is that it would take Wells Fargo a good 45, 60, maybe even 75 days to lend you that money. Bank of America is not going to wait that long. Bank of America is going to sell that property to the first person that walks through the door with cash. And that's where private lenders come in, and that's why they're so important. Private lenders, they move with speed. That is why we're crucial, and that's why it is that investors are willing to pay such high interest rates. Because again, if you go back to that earlier slide where you have a $40,000 profit opportunity, well, that investor, if they don't have their own cash, or if they don't want to use their own cash, they can't even access that $40,000 of profit without the private lender. So in any case, we have the collateral, and again, EquityBuild, there's a whole bunch of analysis that goes into determining whether or not that collateral is even worthy of coming to the picture in the first place. You have the mortgagee, who we just went over, is a very, very strong credit-worthy individual. And then you have the exit strategy. The exit strategy is either going to be a refinance if it's a rental property, or it's going to be a sale to a retail buyer, so somebody that's going to live in the building if it's a flip. So how do we minimize the risk with the borrower? Well, first of all, a full loan application, credit check, income, asset verification, attorney doc prep and review. So those are all the documents. We have a note and a mortgage. Sometimes, if it's needed, cross-collateralization. So that's if they have, maybe lower credit. You would go and look at another property that they might own free and clear and place a lien against that property. There are late fees, default interest rates, interest reserves. That's typically on larger construction projects. We will hold the actual interest that the borrower would have to pay and hold that in a reserve account. Construction escrows, so we take the construction funds, hold them in an escrow account, and only release them to the contractor when, it's called in draws, where an inspector will go out, depending on the size of the building, anywhere from 3 to 6 times, and the inspector will go out and look at the work that the contractor has done and verify that the contractor has done that work, and if that inspection report comes back as valid that they have done that work, then we go ahead and we release the funds. We will take personal guarantees if the property is being bought by an LLC, and really it's the use of experts. I mean, you have inspectors, you have title clerks, so title agency, underwriters, and in other banks we have title closing attorneys, so on and so forth. So how do we minimize risk with respect to the property? So number one, we will establish the quick sale value of the property. The quick sale value of the property is what the property would sell for. Some people would call it a fire sale value. Typically that's between 5% to 10% below the market value. We do title search and title policy, issue a title policy to make sure that there are no liens against the property. If there are, they're covered for by the title policy. Every property gets hazard insurance. It starts with builder's risk insurance once there's a renovation going on, and converts over to a hazard policy. Again, those construction escrows, and there's no less than a 35% equity cushion. Sometimes, well, it can be a little bit higher than that. It depends on the situation. It depends on whether it's a flip. It depends on whether it's a commercial building or a residential building. And again, the use of experts. So who uses private mortgage loans? This we just went over, that time crunch, that the investor that has that need for speed, and it's for the use of finishing projects that are unstabilized or unfinished. And so what's really the 3 requirements to being a private mortgage lender? Well, number one, you need access to capital. 2, access to private mortgage deals, and 3, access to experts. The typical lender in this business will see 100 deals before lending on one. That is an awful lot of marketing. Now, you might have friends or family that are in the business that approach you where it's a little bit easier for you to find access to deals. But if you have to start from scratch, you don't have any friends or family that are in the business, then this is the typical ratio. And what are the kinds of returns that our investors achieve? Well, so all of our investors get a 12% return on their loans. So the way that the structure works is that, again, we're a servicing company. So the lender is lending directly to the borrower at a rate of 15% actually, but we are contracted with our lenders where for servicing the loan, we collect 3% of that 15%. And so all of our lenders get a 12% return, with the rare occasion that there's a one-off deal that will realize higher returns. And as you can see from this graph, if you're investing, and these are just examples, these are not minimum amounts, this is just an example. If you're investing with an initial amount of $250,000, you can see the difference between investing in a high-yield CD at 1.55% or investing in a private mortgage loan at 12%. There's a massive difference by the end of, first of all, even year 1, almost a $30,000 difference. But at the end of year 20, you have a $2.3 million difference almost. So let's walk through a sample transaction. So this borrower was looking for a loan amount of $166,000. What you see to the right of the 266, the ARV, that stands for after repair value. So we determined based on the market and what the market is telling us of the values in the area that once we do a specific style kind of rehab based on what the market is doing, that we will achieve that price. And so in this case, the loan to value is 62%. The term is a 15-month balloon, and really what that means is that all along the way, it's simple interest payments monthly, and then at the end of that 15 months, the full principal is due. And the investor return was 12%. In all cases, we collect somewhere near 3 months of prepaid interest up front. It depends on the day of the month that we close, but it's right around that amount. It's right around 3 months. And so that comes straight from the closing. And in this case, the exit strategy was a refinance. This person is looking to hold it and rent out the property, and they had a credit score of 805. So if you want higher returns, you can become a buyer. So who are EquityBuild's clients? Number one, you have the income investors, and those are people that are looking to build wealth by buying and holding rental properties. So they're looking to build a portfolio of cash flow producing properties. And then you have fix and flip investors. And so these are investors that capitalize on the ability to buy low, add value through top quality rehabs, and then sell to a retail buyer. That is somebody that will live in the property. So let's walk through option one, the building of a rental portfolio. So, as we said earlier, foreclosures mean opportunities and renters. And you have equity positions of anywhere from 30 to 40%. So I'm going to use, for the sake of the example, I'm going to use the term cash on cash return. So that's assuming that you're buying the property with cash. We also have a term cap rate, which is if you're borrowing the money, what the cap rate of the property would be, but I'm not going to use that, so I don't want to confuse things, so let's just use a cash on cash return. So really, if you're buying a property and you're renting out that property and you have an equity position of 30, let's say 30%, let's be conservative, all right? And let's also be conservative and say that your cash on cash return is 15%. Well, what's happening? So if you buy this property and you bought it, let's say for, I don't know, $150,000, and at the end, when it's done being renovated, it'll be worth $230,000, let's just say. Well, what's happening is, first of all, you bought a property that automatically, through the renovation, is now worth $230,000. So your net worth went up by $150 to $230 immediately. That's number one. Number two, you have your cash in a building that is largely protected from inflation, and so you're really getting a net return of, if the cash on cash return again is conservatively 15% and inflation is working against you at 10%, so that's a negative 10, you're really getting a net return of 25%. But let's forget about the inflation for a minute. So you're generating a cash on cash return of 15%. But what's really happening is that the tenant that's in that building, when you go and you refinance this building and you now have a lender that you're paying a mortgage to, well, the tenant in that building, in paying you rent, is covering your expenses, which includes your mortgage, your note payment to your mortgage company. So the renter is actually buying your property for you, because if you have a 30-year loan, by the end of the 30 years, you own that property free and clear. Well, not a dime of your own money went into that. It was all the renter's money. Everything else is just positive cash flow for you. Now, the real power play is the infinite return. How you achieve that, it doesn't happen in every case, but it can happen. And that's if you get into a property below that 30% equity position, so I'm sorry, a larger position than 30%, all right, and you paid cash for that building, or you don't even have to pay cash, you can put a down payment for it, on it. When you go and you do what's called a cash out refinance, where you're able to refinance and take some cash out, if the equity position, again, was greater than that 30%, you will be able, in many cases, to take the full investment amount out, which means you have $0 in this property. If you have $0 in this property, yet it's generating you some income, some positive income, well, that's an infinite return. So the average property for us will generate, once you have a permanent loan, the average property will generate around $500 in net income per door. So if you're in a 2-unit building, somewhere in the neighborhood of $1,000 a month in net income. So in this example with the infinite return, you were able to do a cash out refinance. So you took all of your money back out. You have no money in the property, yet you're generating $1,000 a month in net income. If you continue to do this and build that portfolio, you are generating a whole bunch of those $1,000 net incomes every month with no money in the property. So let's look at a sample transaction. So this is a 2-unit building. The purchase price was $64,500. The renovation, $80,000. Total investment was $144,500. So the market value after repairs was $224,000. The loan to value was 64.5%. So if it's a cash purchase, that would just be cost to value. The gross income on this building was $28,692. The net income, $20,463 for the year. That's a cash-on-cash return of 14.2%. Here's an example of a rental property. These are before and after pics. We, in all of our projects, strip down to the brick and rebuild from there. We do not do cosmetic rehabs. What we do not want to do is get into a building, have had some other contractor in there that we're putting, a cosmetic renovation on top of their work, and find out that there were problems in the way that they renovated that building later on. We don't want to have that headache, and we don't want to be delivering that headache to our clients. So we strip every project down to the brick, and what you see on the right-hand side is the finished product. So we've completely changed the layouts. When you walk into one of our buildings, for instance, if you're in the city of Chicago, the standard building is you walk in, you have a living room, you walk through a hallway, you have bedrooms, and then you are dumped into the kitchen on the back side of the building. All right? When we gut the building out, we change the whole configuration. We put the master bedroom in the back. It's a master suite. We have a powder room in the hall, and depending on the layout, could be 2 bedrooms in that hall as well. And then we bring the kitchen up to the front with a complete open floor plan to the dining room, living room. That's the way that people want to live today. It makes the property much more desirable, increases values on the back end, and increases the rents that can be achieved. So what's in it for me? First of all, the markets. By using that proprietary econometric model, we're really transporting the buyer from a market that doesn't work to a market that works. And it's all about cash flow. We are not speculators. The neighborhoods. So we focus on transitioning or black swan neighborhoods. It says, "Nice job, Mom." So a quick story there is to kind of tell you what I mean by a black swan neighborhood. Well, in Philadelphia, my mother bought a property. For any of you that are familiar with Philadelphia, there's South Street. It's a pretty famous street in Philadelphia. And between 9th and 10th and South and Bainbridge, there's this tiny little street called Delhi. And she bought a property there when that area was horrible. And what happened over time was a Whole Foods came in, and then a Starbucks, and then on the corner a posh BYOB, and then a high-end hair salon, and so on and so forth. And so that's what I call a black swan neighborhood. That's not something that you could ever foresee happening, but it happened to her. So she bought a property for $20,000, probably put $20,000 into it, and now all of a sudden that property is worth $500,000 because of what happened in the neighborhood. The properties. So we work with asset managers at banks, with bulk REO buyers. We use bird dogs. A bird dog, really, that's anybody that has access to property. It can be a lawyer, it can be a friend of yours that has access to properties. It does not have to be a realtor. But so we have this whole system in place where we put out about 200 to 250 offers a week. 50% of our offers are accepted right now. Now, we don't do that many properties because, mind you, going back to what I had said earlier, where we do 3 inspections before we even buy a property, and we have our attorneys looking into what kinds of liens, judgments, and administrative hearings there might be or violations, most of those deals get killed. They don't fit the model. There are problems, bad foundation, structural issues. Most of those deals get killed. But we have a really high acceptance rate, and what you know as a buyer and also as a lender is that that property that is on our website or that has been positioned to you for your portfolio has made it through that inspection process. And if it's made it through in that inspection process, you can rest assured it is a really strong property. The construction. You saw the pictures. You saw the resume of Ken Asbridge. It's really top quality. You know, it's one of the best in our business. We do a phenomenal job. The renters. We have a 4% vacancy rate across the board, so it's a 96% occupancy rate, and we have it for a reason. You can see, again, the quality of the craftsmanship. We have a really stringent selection process in the leasing process to find tenants. And then we have our guarantees, which I haven't gotten into and I will get into. We have a rent guarantee, a maintenance guarantee, and a loss guarantee. So wait a little bit and I will get into that. And then it's the passivity. Look, in the end, as I was saying earlier with Malcolm Gladwell's Outliers, it takes 10,000 hours. You have spent 10,000 hours in whatever it is that you are doing or have done. And it allows you the opportunity to focus on that which drives income into your home, that which you've spent that 10,000 hours focusing on. Or if you're retired, your hobby. It allows you to sit back, kick your feet up on a desk, and focus on the things that are important to you while we build wealth for you. So what are the 3 guarantees? Well, first of all, we have a rent guarantee. So the rent guarantee states that on the 91st day after the renovation is completed, so it gives us some time to find tenants, although I will tell you it really does not take us very long to find tenants, but it gives us time to find tenants. So on the 91st day after the renovation is completed, for 1 full year, we will cover all of your expenses if the income does not cover them for you. So it's some variation of the two if it needs to be. So it's either your income covering all your expenses and delivering some positive income, some net income for you, or if there's not enough income, then it will be EquityBuild subsidizing that difference. And at the same time, the maintenance guarantee goes into effect. So any maintenance for that whole calendar year, so those are tenant-related issues, right? That's what maintenance is. So any maintenance is covered. And we also, first of all, guarantee our rehab. So if anything were to pop up that was rehab-related, that would be covered as well. We also have a loss guarantee. And so really what this means is that the value of the property will not drop below the amount that you invested in the property or that was invested in the property for you. So if you borrowed money, then that it won't drop below that amount either, or we will subsidize the difference. The infinite return. I'm going to skip past the slide because we've discussed this already. Option 2, building a flipping portfolio. So this is the capital building model, whereas the rental portfolio model is kind of a mix between the cash flow model and the capital building model, and the lending model is the cash flow model. So the flipping model is strictly capital building. So with flipping, it's fast turns of your cash. It's between 3 and 5 months, and they're high-end rehabs in the lower to middle income neighborhoods. You're going to get returns of anywhere from 10 to 15% per turn, which means 25 to 35% to 37.5% plus APR per year, right? So, in the absolute worst case scenario, something happens, maybe a permitting issue is delayed, and you actually go to 6 months, right? Still, and again, let's say worst case scenario, the return is it's a 10% return in that 6 months. You're still targeting a 20% return for the year. And in addition to that, there's a very high demand for these properties right now. Let's go through a sample flip transaction. So it's a single-family bungalow. The purchase price was $23,000. Renovation $95,200. Total investment $118,200. Market value after repairs is $172,000. The gross profit after the closing costs is $41,800. And the net income after we get our share of the profits is $24,648. So on the flips, we make no money up front. All of the money is made when it is that the property sells, and you earn, and our investor earns their money. So in that case, really, if you think about it, our incentives are aligned with yours. We want to get through the renovation as quickly as possible. We want to get that building sold as quickly as possible because we want to access our profit just like you want to access your profit. So in this case, the net income was $24,648. This was a really, really strong deal that had a 20.9% return in 3 to 5 months, which is an effective APR of 52.25% to 62.7%. Again, that was an exceptional deal. The earlier slide that said between 10 and 15% is more realistic. But really, we target about 2.5 turns of the money a year. So here's some before and after pics. So as you can see, again, that second picture is the building before we demoed it, so before any demolition was done. The third picture, as you can see, we stripped it all the way down to the studs. And on the right-hand side, that's the fully finished product. What's in it for me? Similar thing as the slide for the rental model. The difference here is a little bit further down where it comes to the marketing. When we market the property, it goes to 500 plus websites. And our average market time, actually, this webinar, this slide is a little bit old. The average market time is 14 days now. So remember in the beginning I said if you stayed to the very end, you would get a little tidbit as to how you can supercharge your capital, something that our clients have been employing and can employ to catapult their earnings to a much higher level. So I am using a premise of $1 million in capital to start with. Again, as I said earlier, that is by no means a minimum. This is just an example. So step one, you take 20% of it, $200,000, and lend it. And what that achieves is just simple cash flow, $2,000 a month, every single month, and that takes care of the cash flow element. Then step two, invest $400,000 in rental properties. Well, remember, because you're buying them at no worse than 70% cost to value, the value of those properties is $570,000 once they're renovated. You refinance, and this is if you're doing a cash out refinance and everything was perfect as far as equity was concerned, you refinance and you get $427,500 back. It's a net income of $4,000 a month. You now have the assets, the income, and the capital back. Step three, you invest the other $400,000. So remember, you invested $200,000 in lending, $400,000 in rental properties, all at the exact same time. You would invest $400,000 in flips. Well, let's take the average return. Say it's 13% per flip, and at 2.5 flips per year. Well, that is $130,000 in annual profit. That is very close to adding an actual rental property to the portfolio, which you can then do another cash out refinance on, take that cash out, go deploy it towards another rental property, and continue building in that way. So now that you're adding the rental property to your rental portfolio, you've got more capital to work with, you've got more income, and a larger volume of a larger net worth. That is a really phenomenal way to supercharge your capital. You know, it's something that our clients are employing today, and I mean, you can imagine that really in the end, the ultimate ambition is to have a large portfolio of cash flow producing rental properties that are fully leveraged so that you have your cash to be able to go invest in more property. And the more flips you do, the more profit that you're able to generate, the more of those rental properties you're able to get. So, can I do this myself? Well, you can, but why? Your returns will be lower, likely, and you'll have to do all the work. It's really, really difficult right now to break into this industry. A lot of the regulations that have come out of the collapse of the real estate market have funneled a lot of the buying power from the little guy to the big companies. And so companies like ours really have most of the buying power. And if you're an individual investor sitting in a car with a realtor, you've already lost. Or if you're an individual investor trying to bid at the courthouse steps or on REOs, on bankrolls, it's really, really difficult to get good properties. It's really difficult to have the necessary research done to determine that the properties are really good properties. It's difficult to have the right team for renovation and not get burned on that. When you have a large company like ours and you have the experience that we have behind it all, we're able to absorb a lot of those bumps in the roads, number one, if they do happen, and number two, because of the experience and the systems that we put in place, most of those bumps don't occur. So the power really is in our systems, and from a cost efficiency perspective, it just doesn't make sense. Obviously, we're on this webinar. You can invest through your retirement accounts, and that can be, whether it's a 401k or an IRA, self-directed retirement account, it doesn't really matter. And that is it. This is contact info for us. If you want to get a hold of us, this is how you reach us. Call, email, and let's get started. Thank you for having me on tonight, everybody. Any questions?
All right, thank you very much. Yeah, we definitely do. I'm going to go ahead and flip this over to our welcome screen again. That way you can see some more of our contact information. So just 1 second, I'll leave it here on Shaun's screen so that you guys can take down this information as well. But thanks a ton, Shaun. You really gave us a ton of information to work through, and we have a bunch of questions coming through. So I will get started on those.
Okay.
Who do you represent? Is it the buyer of the property or those that are lending the funds? You can't represent both, can you?
We can. Absolutely. There's no reason why we can't. There's no rule, no regulation that says that we can't. We have two different companies, EquityBuild that's representing the buyer, and EquityBuild Finance that is representing the lender. And what you have to imagine is that we are in the business of building lifelong relationships with our clients, and that's both on the buying side and on the lending side. And so because we're in the business of building lifelong relationships with our clients, on the buying side, we have instituted those systems and those guarantees and whatever policies we can to make sure that their buying experience is the best it can possibly be. Well, that only benefits the lender. That always has the lender's best interest in mind. So in the typical lending environment where you don't have control over the buying side of things, there is a little bit of a contention between the two sides. The lender is going to hedge their bets. They're going to, in some sense, and this is kind of an unspoken in the industry, private lenders kind of hope for a foreclosure. And they hope for a foreclosure because there's more profit in a foreclosure. Not that they are wishing ill will on anybody, but that they can really earn more money if they foreclose on that property, or that property is deeded back to them, and they can then sell the property and and generate those windfall profits. And so there is that point of contention if you're only a lender, and there's also a bit of a veil of ignorance if you're only a lender, in that you're lending to somebody that is borrowing the funds to renovate a property, but you don't really know how good they are at renovating properties, and you don't really know, if the people that they've hired are good at it, and so there's a bit of a leap of faith there as well. But because it's a self-contained sphere with us, where we control every element of the process, and we have everybody's best interests at heart, we've aligned the systems in such a way where every positive thing that we do for the buyer benefits the lender, and every positive thing we do for the lender benefits the buyer. So absolutely, we can represent both.
Awesome. Awesome. So we have a two-parter here. So what are all the markets that you're currently active in, and what can I do to work with your stuff here in Arizona?
Okay. So we focus on Chicago, and that's it. And there are many reasons why we focus on Chicago, but really Chicago is one of the best markets in the country right now, if not the best market in the country right now. The cash flow that can be achieved in Chicago is astounding. I know Arizona to some extent. One of my real estate consultants lived in Arizona for a while, did this business in Arizona, and it's hard to find product in Arizona right now. And it's not only hard to find product, but it's hard to get the kind of cash flow that you're looking for. I had a developer in Arizona come to us to potentially build a relationship with us and start doing projects in Chicago, because they just couldn't make it work anymore in Arizona. There really is a reason why we've selected Chicago. I could go through various markets across the country and why it is that they're not that great, or why maybe they're good but not as good as Chicago, but we do only right now focus on Chicago.
Awesome, awesome. Okay, so what liabilities exist for the clients of EquityBuild with regards to rental properties, and how do they ensure or protect the investor? Is it a first position lien? You want to expand on that a little bit?
I think I kind of heard two questions in there, so I'm not really sure. Yeah, I'm not really sure what the intention behind it was. So it sounded like one was from the perspective of the rental property buyer, and then on the other side of the coin, from the perspective of the lender. The lender always has a first position lien, so that is the protection. That's the major protection. On the buy side, really there's liability insurance. There's all the contractors. We have lien waivers signed from all the contractors. We have they all have their own liability insurance. There's liability within the homeowners insurance as well when it converts over from builder's risk. We recommend that every property be bought in its own independent LLC. Beyond that, there really isn't that much that can happen. I mean, if you're buying the property in its own LLC, and that LLC by name does not reference you in any way, and in addition to that, if you have the liability insurance, there really isn't anything else that that could happen that you would want to prepare yourself for.
Okay, and then what is the minimum need to start with EquityBuild from a flipping standpoint, or just from in an investment? What's the minimum requirement you guys are looking for?
The minimum is $20,000.
$20,000.
And that's across.
Okay, and go ahead.
That's across the board.
Gotcha. And somebody had asked if you were interested in the Sarasota market.
No, funny enough, we are headquartered in Southwest Florida, in Marco Island and Naples. Been there since '93. I personally, a year and a half ago, moved to just outside of Dallas in Plano, Texas. But we've never liked especially the southern Florida markets. Even Orlando and down. But they're typically overpriced. You have foreign investors that come in, bid up the price of the properties at the courthouse steps. You have, there are speculators that are still speculating on future value, and they're just typically not great markets. Now, I'm not terribly familiar with Sarasota. We typically focus on larger markets, but right now we are fully committed to to Chicago. We will expand out when need be. And with Rebuilding America, we will be expanding out, but that won't be for some time.
Gotcha. And so this one may be one that Erica can chime in on as well. If I set up an LLC to make my investment, am I the managing member? If I invest in real estate using my LLC, can I make additional capital contributions to my LLC?
Shaun, I was actually just going to refer to you. I've overseen a few of the deals that we've pushed through for your company, and it looks like you guys kind of sort of do all the legwork. That you have the LLC operating agreement established already. You have, or a general partnership agreement I've seen in accompanied by a loan servicing agreement. So it seems to me like this is kind of a one-stop shop where that's all sort of implemented. So that's something with regard to the LLC or the partnership agreement being established. If somebody's going to come in through that type of an entity, you all sort of deal with that there, and then you can assign the managing member to be a third party or your servicing company or whomever. Is that correct?
Yeah, that's correct, and it is always an LLC. It's not a general partnership. I'm not sure what you're talking across, but it's an LLC.
Okay. And does the IRA-owned LLC have to file a tax return?
No. Well, single member LLC, no. Multi-member LLC with a personal membership interest, that's generally when you would be looking at a tax return.
Okay. And so what is the minimum time frame for the flipping or rentals if this time frame is not long-term for the potential investor?
So for flipping, let's just say that the average is going to, we're targeting 2.5 turns a year, so let's just be conservative and say it's 5 months. That's a flip. The rental model, I get this question asked of me a lot. I am very much of the opinion, from my background in finance and economics, I am very much of the opinion that you should hold on to a rental property forever, and you should have a 1,000-year loan on it if you can get it. And so, the reason I want a 1,000-year loan, if I can get it, is, and I know I'm speaking in ridiculous terms, but I'm trying to illustrate a point, is because if I borrow $150,000 for 1,000 years, well, when I go pay back that $150,000 in 1,000 years, well, I'm paying it back with money in 1,000 year from now dollars, which is going to be worth pennies on the dollar as to what it is today. So I'm placing the inflationary pressure onto the bank, onto the lending institution. And I don't really see any reason to get rid of a rental property. It's generating you somewhere in the neighborhood of a 15 to 20, or 25% cash-on-cash return or cap rate. And the only reason you would get rid of it is if something happens in the market, both negative and positive. So, if all of a sudden you bought in a market where something really positive happens and values skyrocket, well, get out, take that profit and go buy more rental properties. But other than that, and on the flip side, if something horrible were to happen in that market, I don't know, some like a Jeffrey Dahmer moves into into the neighborhood, or something horrible happens in that neighborhood and values plummet, right? Again, potentially in that scenario, and that's not universally. It really depends on what happens in that situation, but potentially you would want to get out. But other than that, I really see no reason to make it a short-term model.
Gotcha. And I got a quick question here for you. Do you guys currently have an office in Chicago?
We do. Yeah.
A local office?
So in Frankfort, Illinois. So GSLO has about 25 people sitting in an office there. It's a really impressive place. So if that person that asked that question is from Chicago, anybody that's from Chicago or that area, first of all, anybody in the country, you're more than welcome to come visit our offices in Chicago. And yeah, that offer extends to anyone. But it is a pretty impressive place, and we have a whole presentation that we go through. It'll take you around property tours, and it's a really nice experience. You'd be very impressed by the experience.
Okay. What would be a good strategy for investing $100,000 from an IRA?
I would really recommend flips. because there's really no benefit in the cash flow since it's going into your IRA, and it's really hard to get a non-recourse loan. There are only 2 lenders out there that do it on residential properties. We haven't found one yet that does it on commercial, although I'll be honest with you, we haven't looked too hard. But the it's really hard to get a non-recourse loan to be able to get your $100,000 back out. So a flip is really the best thing to do. And really, since it's your IRA, you want that to grow and grow and grow as fast as is humanly possible. And really the best way to do that is through flips. That's the capital accumulation model.
Yep, and that's the one, that's what we primarily see pretty much every day at iPlanGroup. So moving along, in a larger deal, when you pull smaller investments into a large amount, how do I maintain a first position lien in the property?
So what happens is the LLC is formed. Each investor owns their pro rata share of that LLC, and the LLC is what's lending in the first position. So you own your pro rata share of the LLC that has the first lien position.
Gotcha. I have always thought LLCs were the best way to go. Recently I was told that putting property in a land trust, Illinois style, was best way. Do you have any comments on that?
You know what? I don't right now. No, sorry. I would want to do a little bit more research on it because, it's not that element of it is not such a concern for me. We've never had anybody get sued over the, and we've never had one of their LLCs where the corporate veil has been pierced. So it's such a small percent, it's such a low probability of it ever even happening that I've really not devoted the time and energy to determine, to investigate what the, what the safest of all the options are, especially because LLCs, look, if you have a Nevada LLC or a Delaware LLC, you're typically going to be pretty okay anyway. But yes, you can always do better, and maybe a land trust is better. I know like an Alaskan dynasty trust is a very safe way, but again, I don't know much about these things.
Gotcha. So are you running into any competition getting properties from the hedge funds that are buying thousands of foreclosures?
No, actually. I've gotten that question a lot, and I know the media is really trying to show that they're really hyping this concept that the hedge funds are buying up everything and there's no more inventory and that the foreclosures are disappearing. But that's just not what we are experiencing. In fact, we're seeing foreclosures go up. There was a shadow inventory that that wasn't released, and is being released. I'm just not seeing that. Now, you might see that in markets like California or Florida or maybe even Arizona or, Vegas. But I don't know, and that's definitely not happening in the Chicago market.
Okay, and then aren't there taxes to your IRA if you use non-recourse loan?
Yes.
I don't know the answer to that question. I'll have to defer to you.
Yes. Yeah, the general thing, and I generally try to, and here again, because we can't give investment advice, I still try to recommend if you can avoid non-recourse lending with an IRA, if you can do a deal where that's not required, it's generally the best unless the numbers work out for you. Simple example, and this concept can be applied with really any deal. If you have a $100,000 piece of property, you only have $50,000 available in the IRA. You need to secure financing for the other $50,000. That loan has to be basically secured by the IRA. It has to be non-recourse. You cannot personally guarantee the loan. Flash forward, you generate a profit, $50,000. Since you made that purchase and it belongs to the IRA, but you used money that did not entirely belong to the IRA to begin with, and you used a 50-50 ratio, so 50% was financed, that now means that 50% of your profit is now going to be subject to an unrelated business income tax, which last time I checked was a flat tax of 35%. So you're looking at a 35% tax on $25,000 that needs to be paid out of the IRA. And on top of that, the IRA is also obviously responsible for paying that liability, the loan. So, you know, unless the numbers make sense for you and you're still earning that rate of return of, you know, between whatever, rate of return can be different for different people, or based on what's acceptable. So say if you're still able to earn 12% rate of return, then it would make sense. Not all individuals are aware of that going into it, that may not have a significant amount enough down to where now the IRA is basically operating in the red. If you're looking into a non-recourse loan, you definitely want to take into consideration what's it going to cost operating expense-wise out of the IRA to pay that loan back, and any taxes associated with that, to determine if that makes sense for you. Kind of have to crunch some numbers.
Gotcha. Okay, so which investment strategy would you advise for the newbie investor with your group seeking immediate cash return, rental or flip?
Immediate cash return, depends on how immediate. That is a question I can't answer that simply. So it really depends. Let me say this. My real estate consultants are trained by me, also by nature have this, and that is that when we have a prospective client come to us, we dive into their world firstly, get to know who they are, what makes them tick, what their goals are, what their risk analysis filter is like, so what's going to, you know, allow them to lay their head on the pillow comfortably at night. So we just really get into their world completely, understand everything about them, and from that, devise a strategy that makes sense. So it really depends, you know, the answer to that question depends on a lot of factors. Depends on what kind of capital you have to invest. It depends on what immediate means, you know, how you define immediate. Somebody might define immediate as a year. Somebody might define it as, you know, a week. So, you know, it depends on what your short-term goals are, long-term goals. This is really about building wealth long-term and protecting the wealth that you have today. And so that is a very in-depth conversation that needs to be had with one of our consultants.
Yeah, and again, we're going to throw up all of our contact information here, so you'll be able to get in touch with Shaun and his group, and if you have specific IRA questions or LLC questions, we'll have a link that will be provided to you so you can schedule your strategy session, again, with Erica or another member of our team. Continuing on with our questions, we've had some great ones coming through. Do I need to create my own single-member LLC prior to investing with EquityBuild, or does the EquityBuild trade the LLC when I invest with you?
We can help you create it. So it's completely up to you.
Gotcha. All right, and now we have 3 questions, so there's a 3-parter. How is the South Carolina market for real estate? This person knows specific foreign investors, and what information can you give him to help convince those people to become investors?
Oh boy.
Another loaded question.
Yeah, and you know, I think that I really don't have a very good answer, primarily because I don't know much about the South Carolina market, and I think that in order to be able to convince a foreign investor to invest in the South Carolina market, one needs to know about the South Carolina market. So, you know, unless I'm missing something, or if there's, you know, some other element to that question that you know, that was intended behind it, then, you know, that would be my answer. But otherwise, I guess just you know, give me a call and we can discuss it further.
Okay. Yeah, it definitely seems like a lot of the questions for both the self-directed side as well as your side is pretty. They're more conversations than they are questions. So that's great. It looks like we've slowed up on the questions here, so we'll give it another minute here. If anybody has anything else they'd like to address with either Shaun or Erica, please feel free to send this on over. Again, we've gotten this question a lot throughout the presentation, as whether or not this will be available as a recorded version. We will make it available on our website at iPlanGroup.com, and it is in the iLearn section under our webinars. So it'll be there in about 3 or 4 business days, and if you email invest@iPlanGroup.com, I'll also send you a link to download that copy for you without having to go to the website or anything like that. So, yep, you will have all the access you need to the webinar to replay it, so you can go through all the information that we've done today. So it looks like we've slowed up with questions. I'm all out on my end. So If anybody has anything else to throw out there, I just want to say thanks again to Shaun. This is great, and I can't express how grateful we are getting you on here to be able to give this much information for everybody. The questions have been great for everybody. Thanks a lot for getting on here tonight. Shaun's going to be on with us again in the future with some more topics as well. So we appreciate him and also everybody else getting on this call tonight. So if there's anything else you'd like to throw in there, Shaun?
No, just thank you to everybody for staying on. We really had a lot of people stay through the end. Thank you for your time, and thank you, Derek and Erica.
Yep.
Yeah, thank
Awesome.
you
All
so
right.
much, Shaun. This was very, very beneficial.
I appreciate it.
All right, guys. Well, everybody, I hope you have a great night. We will have this recording available for you here shortly. And thanks. We'll see you again next week.
Have a good one.